They didn't do even anything. We weren't even able to work because of there's no electricity, you know. So today we quickly let us look on the first hour. Let us look on prospective, like notes. I'm going to discuss. Let us first discuss about prospective financial information, isn't it? And what are the responsibility of the auditor on prospective financial information? What do you have to consider if a client asks you probably to review information prepared based on estimates? You see, and again, what are the examination procedure that you may perform if you are given probably the cash flow or forecast, profit and loss forecast, capital budget and stuff. That's what we want to look at. Then we go in the next hour, I'm sure. Then we do that question that I've sent. I'm sure that we've went through over and over, isn't it? That question. September 2018. I've sent it in advance. So you may write, yes, so you may write prospective financial information. Prospective financial information. Prospective financial information. So in short term, we say PFI in caps, PFI. When I talk about financial information, I'm simply referring to PFI. PFI stands for prospective financial information. So PFI means information about future financial performance, means information about future financial performance, comma, future financial position, comma, future cash flows, and future movements in equity based on assumptions about future events and the course of action. That's what prospective financial information means. It simply means information about future financial performance, future financial position, future cash flows, and future movements in equity based on assumptions about future events and the course of action. So in short, we are saying a prospective financial information is information based on assumptions. Is information based on what? On assumptions about events that may occur in the future. About events that may occur in the future and possible actions by an entity. In short, that's what I'm trying to say. Simply means it's information based on assumptions about events that may occur in the future and possible actions by an entity. So, which means prospective financial information is highly subjective. Is what? Is highly subjective. If I'm saying is highly subjective, can someone try to explain or to expound? The word subjective is highly subjective. Hello? The word subjective. Yes, can someone try?
Subjective means that people can arrive at different conclusions based on the information that they have. They can have differing opinions.
Okay. Highly subjective, which means that kind of information is prepared based on assumptions. Based on what? Based on what? On assumption. That's what it says highly subjective, which is the client's management They were using their professional judgment. They were using what? Their professional judgment. So it is based on personal opinions and feelings rather than on facts, isn't it? That's what I'm trying to say. It's based on what? Personal opinions. That's why I'm saying it's highly subjective. So, which means it's a difficult area to examine you as an auditor and to report on. So then say, so it means it is a difficult area to examine and report on us as to us as auditors. So it means it is a difficult area to examine and report on to us as auditors. So in exam, you may be given a good example of prospective financial information. Let me give you, for example, cash flows. So the client's manager, they may prepare cash flow statements, which means probably for the next 2 or 3 years. But those cash flows are based on their opinion, on personal opinion. That's why I say they are highly subjective. Do you remember when we were doing SBR? Hello? We are talking about profit or loss forecast. These are another good example of prospective financial information. Profit or loss forecast. We are looking on other things like capital expenditures, budgets, capital expenditure budgets. So, in our syllabus, in our studies, these are the key areas usually examined when they examine about PFI. These are 3 areas they focus on. So they may choose either a profit or loss forecast, or else they may choose a cash flow, or sometimes they may choose a capital expenditure budget. You may be required to examine it and to report on it. Any question? Hello?
None. I don't have a question.
Okay, it's fine. So PFI, they can be they can be of 2 types, or probably it can be combined, be a combination of those 2 types. So PFI can be a forecast or either a projection. So you must know what is the difference between forecast and projection. What is the difference between forecast and projection? What is the difference?
I think a forecast is what is expected to happen.
Okay. So when talking about a forecast is based upon, yes, a forecast is based upon assumptions. Is based upon what? Is based upon assumptions. Yes, reflecting the conditions the business expects to exist. A forecast is based upon assumptions reflecting the conditions the business expects to exist and the course of action reasonably expected to be followed. Isn't it?
Mm-hmm.
So I like the way the business expects to in other words, which means I say the course of action reasonably expected to be followed. In other words, that's what you call best estimate assumptions. the actions management expects to take. That's what we call what? Best estimate assumptions. So focus in other words, you will say they are best estimate assumptions. Best estimate to assumptions. Hello?
Yes.
Yes. I'm sure. You say something?
No, I didn't.
Okay. So, best estimate assumptions. I remember when we were doing mathematics, the best estimate assumption, I remember when we were doing mathematics, even book 4, whatever, we were talking about mode, mean, and median, do you remember, of the distribution?
Yes.
Best estimate of assumption. Exactly. So, which means that's what the management assumption is to future events, isn't it? They're based on assumptions, focus. They're based on assumptions as to future events which management expects to take place and the actions management expects to take. That's called best estimate assumption. Now projection. What about projection? Projection. A projection, you know what? It's an estimate. It's an estimate again, or it's a forecast of a future situation, but based on a study of present trends. They're based on what?
Study of present trends.
Yes. We are forecasting, we're estimating the future, basing on or by studying or on what is happening right now. What is happening now what's happening now is source of information that going to help us to make our projections, our future, to forecast, to make an estimate. Isn't it? So which means PFI projection, you say, in other words, if you say projection, which means the prospective financial is based on hypothetical assumptions. When talking about projection, which means if prospective financial firm prepared as projections, which means they're based on hypothetical assumptions. They're based on what?
Hypothetical assumptions.
Hypothetical, yes, they're based on a hypothetical assumption. Hypothetical assumption. Isn't it? Right? I'm sure we are together. So now let us look on you as an auditor. If that there are certain things that you have to consider before you accept or agree the terms of the engagement. Altogether, there are certain factors that you have to consider before accepting an engagement or before you agree the terms of the engagement with the directors. So am I right? The auditor should agree the terms of the engagement with the directors. The auditor should agree the terms of the engagement with the directors. So if you're asked to audit, if you're asked to do a review, to prepare to review the prospective financial information, which means it's like you're performing work of mechanical nature. It's a non-audit work. It's what? It's a non-audit work. It's a non-audit work. Because it's a client's director's responsibility. So if you're engaged to review or to examine the prospective financial information, remember that this is a good example of what non-audit work or non-assurance engagement or work of mechanical nature. Which means there are certain things that you have to note down, certain things that you have to be very careful, because there's a risk of performing management's what? Responsibilities. There's a risk of ending up performing management's or director's responsibilities, especially if you are providing this service to an audit client. There are some threats again to your independence. Your objective can be impaired somehow if we are providing it to our current audit client. So the thing that you must note is that the auditor should withdraw from the engagement if the assumptions made. The auditor should withdraw from the engagement if the assumptions made to put together the PFA are unrealistic. The auditor should withdraw from the engagement if the assumptions made to put together the prospective financial information are unrealistic. Are you following on what I'm saying, guys? Hello? Hello? Are you following, guys, what I'm saying? You're welcome, Swanda, you're welcome, Viola, and Grace.
Yes.
Are you following what I'm saying? Are we together? Yeah, then you might write, then say, yeah, that's good. Then say you must keep a line. Then say other factors which the auditor should consider. Other factors which the auditor should consider. These are factors you as an auditor you have to consider when accepting engagement, isn't it? So other factors which the auditor should consider in point form. So just write them in point form. We're going to apply these. The intended use of the information, isn't it? The intended use of what? The intended use of the information. So the intended use of the information. Yes. What else? Threats to independence. Threats to independence. Threats to independence, like self-interest threats, like self-review threats, like advocate threats. Sometimes you may be asked by the probably the client want to raise finance, want to finance its expansion, so they may ask you to review their cash flow forecast. Why? Because probably they are required by they have been requested by the bank, by the loan provider. So in that case, there's a risk, or there's a risk of you may be ended up advocating the client if care not be taken. That's why I'm saying threats to independence Again, it's another thing that you have to consider. It's another factor which is serious. Another factor that whether the information will be for general or limited distribution. Whether the information will be for general or limited distribution. General or limited distribution. What does this statement mean? General or limited distribution. Can someone explain it? General or limited distribution. Hello? Is it going to, in other words, in this case, we're going to consider the recipient who need that information. Is it needed by the bank? Is it needed probably by certain individual stakeholders? That's what determining the distribution of that information. Other factors are availability of experienced staff to carry out the assurance work. To carry out the assurance work, it's another factor that you have. Do we have competent staff? Do we have experienced staff to carry out the assurance work? Another factor that you have to consider is about the elements to be included in the information. 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 Another factor that you have to consider is the period covered by the information. You see, so this some of the even what you have discussed, the nature of assumptions is whether they are best estimate or hypothetical assumptions. It's another factor which is very important again. Whether PFI are best estimate or hypothetical assumptions. That's good. So which means you as an auditor, you should have sufficient knowledge about the client's business and its environment. You should understand, or you should have that sufficient knowledge so that you can able to evaluate the assumptions made by the directors. It emanates from, do you have sufficient knowledge so that you may able to evaluate the significant assumptions made by the client's directors. The other thing that are very practical, do you have enough time? Probably we do have so many clients, so many companies that are auditing. It's another factor that you have to consider again. Do we have time? Do we have time? It's another factor. It's not a matter of just accepting engagement, but you have to consider some of these factors. These are some of the practical matters. Do we have time? Even the degree of secrecy required beyond the normal duty of confidentiality. Is there any degree of secrecy on this engagement? You have to consider again, etc. I'm sure I've mentioned a lot of things. Any question?
None.
None. Okay. So
the question, the max allocation on the question is 6. You've given, I think, in excess of 8. Are you suggesting that in an exam we should write as many points given the number of marks that are allocated?
Okay, we're going that question. So far, let me, this is part of the notes. Notes are general. So in the next hour, when I'm going to look on that, on the question that I've sent, that's where I start to discuss about mark allocation, how to apply these notes.
Okay.
Okay. Thank you. Okay. So you should also know generally what are the procedures that you may perform when you are examining the prospective financial information. You should know. Yes, you have to perform some analytical review. They're very important. Because you're going to give you some figures in 20x1, 20x2, 20x3. You have to perform some analytical review. So your procedure should include what? Analytical review. Probably that's how we started to probably studying this cash flows, revenues. They are increasing. Are they increasing in stuff? Or cost of probably sales and stuff, other things. You have to perform some analytical reviews. They help us as auditors when examining, try to understand the assumption, the reasonability of the assumptions made by what. But after analytical, you have to carry it against similar probably historical projects. You have to compare with those results, analytical review, or with other information. The main issue is that you're trying to assess the reasonability of the assumptions, of the key assumptions, significant assumptions made by the directors. Again, we have to consider the accounting policies normally followed by the company. It's another thing which is very important when we are performing our procedures or when we are carrying out our examinations. The accounting policy is normally followed by the company. Again, we have to consider matters like the procedures followed by the company preparing the forecast. What are the procedures? What were the procedures followed by the company preparing the forecast? So when it comes to accounting policy normally followed by the company, bear this in mind. There should be inconsistent with the accounting policies applied in the preparation of what? Of historical financial information altogether. Yes, there should be a consistent application of those accounting policies. The accounting policy are applied when the client prepared their historical financial statements. They should be applied the same. There should be a consistent application when they are prepared, when they are preparing a forecast as well. So there should be a consistent application of accounting policies. Any question? Hello? So now, this examination process, usually you design them when you're given specific matter. Yes, you design them when you're given specific matter. For example, we are given profit forecast. For example, is it a capital expenditure or a cash flow? Isn't it? It depends with the matter that you are given in the Excel. So if it's a profit focus, profit or loss focus, you know that there's income, there's expenditure. So you must be able to examine income. Probably you are given certain product or a service. You should know the source of referring the market, the prices of those products, the price of those services. The main is that we are trying to understand the reasonability of those figures, of those prices, or probably of a given product or service that is being provided by the client. You have to compare their market, the price of their products, probably with the current market price or with the price that are prevailing on the market. The main issue is to understand the reasonability, to assess the reasonability of those figures, because they are based on, they are based on estimates. Management, like what I've said, management usually when they're preparing prospective and financial information, you know, they are highly subjective, which means they use their personal opinion. They are based on personal opinion. That's what it means. So you as an auditor, you should not accept something at face value. You have to apply what you call professional skepticism. If there's an expenditures, again, you should know the source of the information which you are going to compare with the assumptions made by the management. You should know the source. You should know the source. When you're examining the prospective financial information, sometimes you should know the source. They can say they're expecting to spend, they're expecting probably to spend so much on this. You see, on electricity, for example. Electricity is there in the PFI, probably in the profit and loss forecast as a part of expenditure. You should confirm those figures. Where? You can just review the current bills, electricity bills. In the difference, if there's a difference, the difference should not be significant. To an extent that you as an auditor, you may end up casting a significant doubt on those figures. The difference should be reasonable. Are we together, guys? If they obtain a loan, then there's some interest rates, probably expense, finance cost in the prospective financial information or in the cash flow or in the profit or loss. We have to confirm the rates. Where? From the banks. You see. So that's why most of students say, no, it's a difficult area, I don't know what is it and stuff. Why? Because when they are carrying out the exam, they know where to start, they know how to refer, how to assess the reasonability of whatever you're given. That's what's called examination. They're trying to assess the reasonability of whatever information, whatever figures that are there in the BAT, the cash flow, capital expenditure budgets, profit and loss forecast. Any question? Hello? Any question?
Nothing from me.
Okay, it's fine. Now, after you have examined the prospective financial information, the next thing you have to express an opinion. Of course, yes, you have to express an opinion. You have to express an opinion. You have to express an opinion. Hello? So, which means if I say you have to express an opinion, which means want to hear from you as an auditor after assessment. What's your opinion? What's your opinion after assessment? What's your opinion? In other words, when expressing opinion, you're going to tell us about the client's management, on whether the assumption provide a reasonable basis for the prospective financial information, isn't it? Yes, you have to give a negative assurance, a statement of negative assurance. When expressing an opinion, the auditor should give a statement of negative assurance. Should give a statement of negative assurance as to whether the assumptions provide a reasonable basis for the prospective financial information. When expressing again your opinion, the auditor, you should tell us, you should also tell the client's directors whether the PFI is properly prepared, whether the PFI is properly prepared on the basis of the assumptions and the relevant reporting framework. You should report on that, on whether the PFI is properly prepared on the basis of the assumptions and the relevant reporting framework. These are some of the things that you have to include in your report. So in other words, the auditor, you have to give what you call a limited assurance. A limited assurance. Why we call it limited assurance? Can someone try to explain why we call it a limited assurance? When you are expressing your opinion on PFI, we have to give a limited assurance. There's a limited assurance, there's a reasonable assurance. What is the difference? What is the difference? Viola? Sure. I'm recording the lecture of the other people who need this video, so treble means if you're in a noisy environment, mute yourself for the sake of progress. It's fine. So I'm saying, what did you differ? When I say limited assurance, what does this mean? Limited assurance. Because you are doing audit, you did audit. So a limited assurance means a level of assurance that is less than that provided in an audit. Which means less than that provided in audit, which means in audit we provide what we call a reasonable assurance. Why you have to provide a limited assurance or a level of assurance that is less than that? Because this type of information, they're based, they are subjective. It's a subjective information, isn't it? They're based on assumptions. You see? So in other words, when we are saying about limited assurance, we are saying it is assurance of something in the absence of any evidence arising to the contrary. So using auditor, you're simply saying, I believe that this is reasonable, but because I have no reason to believe otherwise. In layman's terms, you're saying, use auditor. The auditor is saying, I believe that this is reasonable, but I have no reason to believe otherwise. Why? Because they're based on assumptions. That's what's called limited assurance. A level of assurance that is less than that provided in an audit. That's good. That's good. Any question? Before we go to our question, today's question, to our question. Any question, please? Yes, we're done with prospective financial information. The next thing that we have to do is that question that I've sent September. I'm sure you guys you got that question, isn't it? I'm sure. So let me share my screen, and so that we may apply what we have covered. Let me open the question paper. Let me share my screen. The main issue is about application of the knowledge. Application. Are you seeing my screen? Are you seeing my screen? So this one is a past exam for September 2018 past exam paper. Are you seeing it?
It's not.
I'm not seeing anything on the screen. Oh yeah, it has just appeared.
Okay, it's fine. It's fine. What about others?
Okay.
Visible.
Okay. So here, let me read this part. What is it required? The required part. 3A Roman number 1. They say explain the matters which should be considered by Jensen and company before accept the engagement to review and report on Nali's company's prospective financial from 6 months. Then Roman number 2. They say explain assuming Jensen and company accept the engagement. Recommend the examination procedure to be performed in respect of Nali company's forecast statement of profit and loss, 9 months. That's good. So let us read this story together. Let's read this story together. You are an audit manager in a Jensen company which offers a range of audit and other assurance services to its clients. One of your audit clients is Nali Company, which operates a commercial haulage company. Nali Company has been an audit client for the last 5 years and is currently planning a significant expansion of its operations into a new geographical area and jurisdiction. In order to finance the planned expansion, Nali Company needs funds to purchase additional heavy goods, vehicles, expand its warehousing facilities, and recruit more drivers. The company is also planning a major advertising and marketing campaign targeted at potential customers in the new jurisdiction. Second paragraph. Nali Company's finance director, Susan Sidon, has approached you to ask if your firm will provide a report on the prospective financial information, which has been prepared in support of a loan application. Already, they prepared this prospective financial information. You as an auditor, they just need to provide a report on the prospective financial information. So, but the purpose of this, already the purpose of this PFI, the company, they want to obtain loan from the bank, isn't it? They've applied for the loan. So probably the bank or the loan provider needs an audit report. The application is for a new long-term loan of $22 million for the company's current lender, which it intends to use exclusively to finance the planned expansion. Okay, that's good. The company currently has an existing long-term loan of $31 million from the same bank, which is in 5 years. Susan Sidon has provided you with the following extracts from the prospective financial information, which will form part of the company's loan application. So here's the forecast statement of profit and loss. We are given here. So it reads, year ended 31 August 2028 unaudited. Year ending 31 August 2029 forecasted. Year ending 31 August 2010 forecast. We are given revenue, then there's a note on revenue, but by having a mail look, revenue is increasing. Yes, is increasing. Cost of sales, again, we give the note about the cost of sales, and cost of sales also they're increasing. Administrative expenses, again, I'll give you the notes about the administrative expenses. They are decreasing. Operating profits, you're given operating profits. They're projected, they're being forecast to increase significantly. Finance costs, not fall. They are expected to increase, then to decrease at the end of 31 August 2010. Profit before tax, they expect again to be doubling. The forecast to be doubling. Right. Number one, they're talking about revenue, not number one. Revenue represents the amounts derived from the provision of haulage services to commercial customers operating principally in the retail sector. NALI Company's board of directors believe that trade in both its existing and new markets will experience significant growth over the next 2 years. Thus this figure that basing this statement, that they're basing that assumptions they're basing on revenue. Not two, it's about cost of sales. Cost of sales comprises the cost of warehousing and distribution, including relevant staff costs, maintenance and repair of vehicles, and depreciation of property, plant, property, equipment, and vehicles. That's part of cost of sales. Note 3 is about administrative expenses. Administrative expenses are mainly the cost of running NALI Company central head office facility. Finance cost represent the cost of servicing a long-term finance from NALI Company's bankers. Tax code required explain. They're not say state, explain the matters which should be considered by Jensen Company. Jensen Company is an audit firm. Altogether. So if you want to understand this question very carefully, please be involved into the situation. Yes, get involved. They say Jensen Company, which means our audit firm. Explain the matter which should be considered by Jensen Company before accepting the engagement to review and report on NALI Company's process financial information. 6 marks. They explain them. Then someone is saying, say, how many points we should raise? How many points we should raise? Someone is asking. Say how many points we should raise? So in this case, they say explain, which means you'll be given a maximum of 2 marks for each matter explained. You'll be given what? Maximum of 2 marks. Are you following what I'm saying? You'll be given maximum of 2 marks per each point well explained. Altogether, there's someone who was saying, say, how many points you should write. Yeah, guys, are we together? So in this case, they say 6 marks. Yes, maximum of 2 marks per way to get 6 marks. So it's wiser to make them 4, isn't it? I would say minimum. I've been mentioning about 5 maximum. I say minimum. It is important because time management, most of the students fail because they fail to manage their time. They know how many points raised. So in this case, from the introduction, we have been told about that this one, we are going to provide this service. No, Nali company is our current order, isn't it? It is clearly written. It's a factor, isn't it? So you may write matters to be considered before accepting of engagement. Roman numeral 1, matters to be considered before acceptance of engagement. Are you writing? If you're writing, explain, which means make it clear. Why are you going to just ethical threats, then full stop? No. These were general notes. We're going to up those notes. Now we're going to relate them to this scenario now. That's why they say explain. Make it clear. Do not state. Explain. So in this case, I'm going to read what is written. They say, first paragraph, you're an auditor, audit manager in Jensen company, which offers a range of audit and other assurance services to its clients. One of your audit clients is Nali company, which operates a commercial haulage, company. It's our client, I'm sure, audit client for the last 5 years, and is currently planning a significant expansion of its operations into a new geographical area and jurisdiction. In order to finance the planned expansion, Nali company needs funds to purchase additional heavy goods vehicles, expand its warehousing facilities, and recruit more drivers. The company is also planning a major advertising and marketing campaign targeted at a potential customer in the new jurisdiction. So in this case, they say Nali company finance director Susan Sidon has approached you to ask if your firm will provide a report on the prospective financial information, which has been prepared in support of a loan application. So this says, which means there's a serious matter there. There's a serious matter we should consider there. Why? Because Nali Kamban is our audit client. So there's some ethical threats there that may arise. So ethical and so clear, you have to, I said in underline, then make it clear. All together. So you write ethical threats and professional issues. Are you writing? Hello?
Yes.
That's good. Ethical threats and the professional, then underline. Then let me make it clear. 2 marks, a lot of marks. Then say, by accepting or Nali Kamban is our audit firm. You can say, is our current audit client. Nali Kamban is our current audit client. Yes, right. Kamban is our current audit client. Nali Kamban is our current audit client. So by providing by providing by providing this service, which means to review of the prospective financial information, isn't it? Review of the prospective financial information. That's what I say, this service, providing service, which means in brackets I'm saying review of the PFI. May create an advocacy threat. May create an advocacy threat. May create an advocacy threat. So there's a risk. So there's a risk that us as auditors we will be biased in favor of the client. Will be biased in favor of the client. Isn't it? So someone can talk about self-review. It depends the angle that you are coming from. Someone can say self-interest threat may arise. It depends where you are coming from and the way you're going to expound your point. It's not a matter of just mentioning a self-interest threat may arise, then you got stuck. So that's ethical threat. I have explained why, or how adverse threat may arise. Because in this case, it seems that you're going to represent, we are representing. Yes, it seems like we are representing the client to obtain finance. So that's what I'm saying. Adverse threat may can be created or may arise. Isn't it? I know there are so many threats, there are so many threats. But please make sure that you won't stuck when you're explaining your point. What else in terms of threats that may arise? I'm going to help you. If you got stuck, because my point is not exhaustive, it's not enough when it comes to threat. So far, I'm talking about ethical threats. And I give reason why this is an audit client. In the provision of a review of PFI, it's a good example of non-audit work, like the other, provision of internal audit service, internal audit function and stuff. Nothing else. First of all, you should let us look on the professional issues. On professional what? So usually when you mention the threat, there's a threat that is significant. In this case, adverse threat is a threat which is significant in this case. So that's why I'm saying, when you're choosing the threat, choose that threat which is most significant. Choose the threat which is what? Most significant. So again, you have to consider, since we say ethical threats, there's ethical threat may arise, which means another factor that we should consider again, safeguards. They should be in place. Therefore, safeguards. Therefore, safeguard they should be in place. Therefore, appropriate safeguard they should be in place. Are you writing? Are you writing? Hello? Is that the fact?
Yes.
Yes. The moment that we've identified that there's a threat of threat, another factor that should consider further, it's about appropriate safeguards. They should be in place. Like what? Then you mention. How best can we safeguard our independence as well as what? Objective. We should use separate. We should use separate with relevant experience who are competent. Isn't it? Here, separate teams, they should be engaged. We have to review the PFI. We are competent to review the PFI, and that we are responsible for the audit. We are done. So I've mentioned about, that's why I said, when I write it as ethical threats and professional issues, I've mentioned, they're not done. Then you'll be given your 2 marks. Then you skip a line, then go on to another point. Any question before we go on to another point? You see now, the difference between notes and the application of the notes. I'm sure that you're learning something. Hello? Yes, there are some notes that are relevant to the scenario. Please relate to the scenario. Don't just write something from nowhere. Look here, I'm relating to the case. The notes, they do not relate to the scenario or to the case. These are general notes. You hear people say we are done with this with the notes. What is this? We should be done with the application of the notes. Yes, now we're talking at this level. The other thing is, I'm going to read. They say, I'm going to read in the second paragraph. They say, Null Company Director Susan Sidon has approached you to ask if your firm will provide a report on the prospective financial information which has been prepared in support of a loan application. So then we say, in our intended use of the information. So in this case, what is the intended use of the information? Hello? Yes, it's not the fact. Yes, you've learned. The notes, that's good. Now, you see, I'm applying the notes. Yes, I know, I've read about over and over about the intended use of the information. So, most of you guys, you fail to relate to the scenario. Okay, it's another factor that you have to consider as an auditor. So I'm right, the intended use of the information. Then underline. The intended what? The intended use of this another fact that you have to consider. Yes. So in this case, yes, I should consider the intended use of the information. What I should consider the intended use of the information, but in this case, it is clear. In this case, the information will be used to what? Yes, which has been prepared in support in support of a loan application. That's good. The PFI has been prepared in support of a loan application. It's clearly stated.
Hello, sir. Are you still connected?